with these chapters throughout the country. And I will tell you, this chapter is special. It's special because of the people involved with it, special because of the content you guys put on. I mean, even a speed reading workshop, like, that does not happen everywhere. It's special because of the commitment to CFA society more broadly. So I thank you, and frankly, I'm humbled that you guys have us in. So thank you for having us here. I'm also excited about our speaker and the content today. I'll get to Steve Deshane, who's our speaker, in a moment, but on the content front, as we all know, many of us in the room are investors, there is no market cap weighted index for the 65-year-old who needs 3% per year. In the absence of that, we all, either as clients, investors, mandate managers, we have to make some active decisions around how we're constructing the portfolio. And I think the research today is important and pertinent, more so now than ever before, because it's around how do you make a good decision around who you're going to abdicate or provide some of that responsibility to. And so I think the work that Steve's done, the work the Capital Group has put in here around what is statistically significant in finding good quality managers is really important work, and hopefully you guys find it helpful today. I'm excited about the speaker because one of the best parts of being a Capital Group American Funds is the colleagues and people I get a chance to work with. And Steve is way up on that list. Funny, thoughtful, and frankly, very intelligent. Steve is a joy to be around. I'm certainly honored to have him here today. In terms of Steve's background, I apologize for reading, but there's a lot here. I just want to make sure you guys have some context around where Steve is coming from. Steve is a research and development director at American Funds, part of Capital Group. He has 25 years of investment industry experience and has been with Capital Group for 6 years. Earlier in his career at Capital, he was a client analytics director, a senior product development manager in investment services, and a senior business manager of defined contribution. Prior to joining Capital, he was a general manager for the Retirement Income Solutions Division at Sun Life Financial. Before that, he was chief marketing officer for Retirement Income at MassMutual Financial Group and product development and marketing lead for defined contribution at Fidelity Investments. Steve is from Boston. Additionally, Steve is a founder of the online financial advice site Empower, now part of Morningstar, which pioneered investment advice in the 401k plan administration space. He holds a bachelor's degree in psychology and social relations from Harvard University, maybe you've heard of it, graduating magna cum laude. Steve is based in Los Angeles, California. It is my honor, my pleasure to introduce to you Steve Deshane.
Thanks very much. I look forward to the opportunity to spend some time with you this afternoon. Can everyone hear me okay? Should I throw the mic on? I don't know. All right. I'll put it on just in case. As Jeff said, this research began about 5 years ago, in part because we thought the active-passive debate had gotten ridiculously one-sided. You know, when you read the academic and trade literature, you'd think that it's technically impossible to do what we do every day, because the markets are efficient, and all the information is already priced into every security that's available. Therefore, there's no advantage to be gained. And yet, you know, we knew our own results. We knew what we'd done for 80+ years, and so we knew that was not true. But that is the efficient market hypothesis that Bert Malkiel and others have laid out in academia. And so we decided to do some research. We went back to 1934, which is when, obviously Capital began, and we looked at every single actively managed mutual fund from 1934 to today. It was pretty easy in the 30s. There were only a couple of dozen of actively managed mutual funds. There was, American Funds and State Street, MFS, Fidelity, a few others, but that's it. But every single time there was a new fund that came into existence, we added it to the data set, looked at it on a monthly returns basis on a rolling period. So rolling 1s, rolling 3s, 5s, 10s, all the way up to 30 years. And by the end of this exercise, we were looking at thousands of mutual funds and millions of data points of analysis. And what did we find in the aggregate? That active management, taken as a whole, erodes value. And it kind of has to. I mean, mathematically, it's 70% plus of the market, and the market can't outperform itself net of fees. But we did find within active management that there were certain managers who had consistently done better. And when we finished that research, actually one of the #1 questions that I got at the end of the first research was, Steve, that was a great testimonial to the American Funds and your 80+ year track record, But who are the other A students? Who are the other managers who consistently added value? And the more important question is, can you help me identify them in advance? Can you help me identify them in a statistically significant way, what the academics call ex ante? And so we decided to do some research on that topic. And so we went out to our plan sponsor clients, we went out to advisors and consultants, and we asked them two questions. The first is, what are you using for your diligence criteria, your algorithm, your key factors? What really matters to you in manager selection? And the second question is a little harder, is how are you holding yourself accountable that those factors are actually adding value in a statistically significant way? And people gave us a lot of answers to the first question. We ended up with 12 factors to look at. The answers to the second question weren't as robust as we might have liked. So we decided to do our own analysis. We looked at those 12 factors individually and then in combination and said, does it add value on a predictive, ex ante, out of sample, fully robust, statistically significant way or not? And we found 2 that did, absolutely. 5 or 6 that were sort of generally valuable, but 2 that were absolutely valuable. The first won't surprise you at all, fees. Fees really do matter. It is hard to win this race if you're charging a lot of money. And fees are obviously not only a direct deduction from results, I mean that's the obvious mathematical part, but when you look at managers' gross of fees, so before you deduct fees, low fee managers outperform high fee managers on a gross of fees basis. Not terribly surprising either when you think about it. How did they get to be low fee managers? Typically it's by adding scale and assets, and hopefully there was some skill that merited those assets being added to that manager, and there's some persistence in that skill. And it turns out there is. So fees matter, and they are a small signal to skill as well. The second factor that we found was manager direct ownership in the fund. What we sort of colloquially call skin in the game, or eating your own cooking. And I do want to give the folks at Morningstar full credit for this. We were sitting down with John Reckenthaler, who's their head of research, and Hal Ratner and Russ Cannell. And we were talking about what works in manager selection, and John said, have you guys looked at manager ownership? And we said, no, we hadn't really looked at it yet. And we believed in it culturally. We believed that it mattered, but we hadn't really looked at it as a principle in manager selection. So we decided to do the research, and we had the data from Morningstar at the time. It was 2014, and we looked at it. It was incredibly powerful, almost as powerful as fees, which really surprised me because obviously, fees are a direct deduction from results. It's got a big mathematical correlation with that predictive power because fees don't change much in the future. But manager ownership was as powerful, and so I had this need to go deeper, and so I went back to John and I said, yeah, your 2014 data is great, but I need all of your data going back to 2004 when the SEC first required every manager to put manager ownership into the statement of additional information. And John essentially apologized. He said, hey, I'm sorry, Steve, in 2004, no one knew it was going to be important. Every manager was supplying information to the SEC differently. Our error rate's way too high, I can't help you. Which left me in a bit of a quandary because I knew it was important, but I couldn't prove it out of sample. I couldn't do the kind of longitudinal analysis that's critical in making sure that you've got something that's relatively robust. And so I actually hired a company in India called Infosys to read every single filing that had been made to the SEC since 2004. 20,000 plus filings, hundreds of pages each. My team was pretty happy, we outsourced that. And so what they came back with was a data set that allowed us to do the testing that you guys would think is important. So you're going to stack rank managers, say, in 2006, and now we're going to look at results of those stack rank managers from highest level of manager ownership to lowest, and we're going to look at results in 2007, 2008, 2009, and say, is it robust, is it predictive, is it stationary, does it work in multiple market environments? And it met every test. It worked in every asset class, It worked in every market environment. It was relatively stationary, and it was tremendously robust across all of those dimensions. So manager ownership matters. And lots of folks have asked me, why? Why is manager ownership so valuable? And I do not believe it's because when you have $1 million or more invested in a fund, that somehow you get up earlier in the morning, and you read more 10Ks. I mean, we're all professionals. We're working as hard as we can to do the right thing for our clients. So there's not more that you can do. I think manager ownership works because it's a proxy for culture. It's a backdoor to asking the most important question of all, which is, are you aligned with your shareholders? Now, the problem with asking the question directly is you get a lot of false positives. So imagine that there were 10 managers up here, and we asked each one of them, are you aligned with shareholders? I mean, they would be falling over themselves to say yes. Let's say it's in our mission statement. Of course we're aligned with shareholders. We care about our shareholders. And they'd probably all be true in what they were saying. They believe that. But manager ownership gives you an indirect way of measuring their degree of alignment. And it turns out that degree of alignment with shareholders matters in results. And this proxy for culture is important because you don't get a good signal on culture by asking about it directly. The research we're going to talk about today goes a little bit deeper. We got a lot of interesting questions and feedback about the original research, and we wanted to explore two things in this research that I'm going to talk about. The first is, what's behind capital success? We have been doing this for a long time. We have an extraordinarily strong and consistent track record, and we wanted to deconstruct what was behind our success, what was behind what allowed us to continuously provide above benchmark returns. But we also thought in deconstructing our own success, there would be an opportunity to identify better signals in manager research. Because anytime we found something that we thought was valuable for us, and that we thought was a good signal or a good contributor to our results, we proved it in the general case. We went and looked at all managers on the same dimension and said, are the managers that have that skill or that cultural trait or that ownership approach or that incentive structure, do they do better than managers that don't? And we found an opportunity to test our own hypotheses against the general case. So I think that the opportunity is for us to look more broadly at manager research and identify things that work. So part of the reason why we believe that manager research matters a lot is that markets are changing a lot. And we'll get into some of that here. But we believe that, as Jeff said, there's no market cap weighted approach to getting, a 3% return for a 65-year-old. There's also no market cap weighted approach to get the same level of risk mitigation and diversification because markets have changed so much. You've got to look at more the individual managers and active management to do that. But in order to make that decision, you've got to have confidence in your manager selection that you're adding value in a statistically significant way. And so we want to look at the factors that allow us to do that and the things that really matter. It's just one example of how much markets have changed. This is the correlation between US and non-US equities. This is going back from 74 to 97. Reasonable correlation. Look at it more recently. I mean, US, non-US isn't providing the same level of diversification as it had been for a good chunk of my career. This has been true across other, cross-country and global equity correlations as well. Markets are getting more correlated. So in order to provide the same level of risk mitigation, diversification, I need to think about active management more specifically to achieve that. I want to take you through our lifetime results just for a second, not just to, sort of have a small commercial moment to talk about our results, although that's certainly part of it, but also to talk about the difference between skill and luck. What you're looking at here is 100% of our equity results from 1934 to today. And it's an extraordinarily long track record where we've averaged 148 basis points of excess return, even at an A share, which has a 12B1. If I take the A share out, we make an institutional share class, it's about 170 basis points of excess return. But the more important thing than just our long-term track record is that there's a tremendous amount of data here. It's 670 years of cumulative equity investing history. And that really matters when you're doing manager selection. I think one of the hardest things to do in manager selection is separating skill from luck. Take a manager who's got a good track record, they beat the benchmark by 150 basis points over 10 years, maybe 7 out of those 10 years they beat the index, 3 they may have given some back. It's a really good track record. But with 10 years of data, what's your opportunity to separate skill from luck? Maybe you get to an 80% confidence level, depending on your dimensions that you're testing, maybe 85. But there's always a significant amount of idiosyncratic security selection that may be driving that result, that may not be skill, that may just be luck, and therefore may be less likely to repeat. You can test that by doing the coin flip exercise of, if I had that skill, that track record, what's my chance of getting 7 out of 10 heads? Well, it turns out chances are pretty good that you can get 7 out of 10 heads. You haven't got enough data to separate skill from luck. But here I've got 670 years of investing history. So when I do the null hypothesis coin flip exercise, it's what's the chance that this track record was produced by luck? So if the null hypothesis is that it's a 50-50 coin flip, and yet we're producing these kinds of results consistently over that many coin flips, what's the odds? And the number was about 8 times 10 to the minus 53rd. That's a number so small it only appears in physics and maybe lottery odds. Actually, lottery odds are smaller. They're like 1 in 300 million. You'd have to win the lottery multiple times in a row to actually produce these results from anything other than a systematic expression of skill. So I can feel pretty good about our track record. I can feel like, all right, not only is it good and long-term and consistent, but there's enough data here to really separate skill from luck. In doing this research, one of the things I did was I went back to the Capital archives. We've been doing this for a long time, and so I thought, I can't be the first person in Capital who's thought about this. And I found this great piece of video from Jim Fullerton, our chairman, who actually talked about how to choose a manager from 40 years ago. And I'll play it for you. I hope I'll play it for you. And if I can't play it for you, I will tell you what he said. Essentially, and I love the video just because I also love Jim's mustache. But if he basically said there were 3 things that matter in choosing a manager. The first is, what's the manager's long-term track record? What are the results? And he would caveat that by saying that past results aren't any guarantee. We're not going to say that tomorrow is going to equal yesterday, but it's the only information you have. And his second question is, what are the factors that went into those results? What produced those results? What was behind it? And the third question is, how likely are those factors to be available in the future? And I think he's exactly spot on. And those are certainly 3 of the broad questions that we try to answer. But I think as an industry, we may spend a little too much time on the first question. We spend a lot of time analyzing past results, the 1, 3, 5, and 10, and we're looking for momentum, and we're really, it's all information we have, but we don't spend as much time, I don't believe, on the fundamental factors of what's driving those results, what's behind it, and asking ourselves, are those factors likely to be repeated? Are they likely to be available in the future, the same market environment? Are they culturally consistent? And we want to focus on those. So when we started this research, there were 4 things that we were looking for in manager selection factors. And they had to meet all 4 of these criteria for us to include them. First, they had to be predictive. I mean, investing would be simple if it came with a time machine. Because we don't have one, everything that we do is geared around how predictive is it of the future? Is it improving my odds of getting a better decision on future out-of-sample or future results? It's got to be relatively stationary. I'm not interested in variables that move around a lot, because obviously that's going to reduce their predictive power in the future. I want things that are robust, things that work in multiple asset classes, different time periods, and different market environments. For the simple reason is I can't predict what the future market environment is going to be. And if I find a factor that only works in up markets, or only works in down markets, it's a lot less valuable to me than something that is going to work in multiple market environments, since I can't predict the future. And finally, I want factors that are relatively intuitive, where the hypothesis behind them makes sense. You know, one of the things I always stress to the folks in my team is, you know, have a point of view of why you think it will work before you come to do the analysis. Otherwise, we're just doing data mining. You know, we're dumping in a lot of data, we're doing a regression, and we're coming up with a finding. Well, findings are okay, and they may lead to a hypothesis, but if you're just kind of examining findings, you get a tremendous number of false positives. You know, one of the best examples of that is if I had the actual day of the week that every manager was born on, you know, Sunday, Monday, Tuesday, and then I run it through an analysis of results, well, one of the days has to win. I mean, by definition. But then when you look at the results, do you really believe that somehow Tuesday managers are brighter than Wednesday managers? No. And is it likely to be predictive of the future? No. Because it's just a data anomaly. It's just an embedded artifact of what you found in the data mining. And we're really focused on removing those things, not acting on those things. And so I spent a lot of time with my team on form your hypothesis first. So we've identified 10 factors. There are 5 that are focused on what we call stewardship, which are less about managing money and more about the business of how you manage the business of managing money. And we think they matter, because we think they relate to culture. And then there are 5 that relate to our investment process, that are actually more related to how you manage money itself. Some that are relatively well-known, and some that maybe are less well-known. And we've looked at each one of these 10 factors and looked at how much they contribute to our own success. 1, what do we think they're adding to the 170 basis points of excess return that we're creating? And then 2, how generalizable are those factors? And how much of a difference do they make in the industry? I'll give you an example of the first one. Our hypothesis is that privately held asset managers will consistently outperform publicly traded asset managers. Turns out to be true. Turns out to be true by about 47 basis points. That is a powerful finding. Now, our hypothesis behind that is based on 2 facts. 1, we think investment cultures are fragile. You've got to find really smart people, you've got to keep really smart people, you've got to motivate really smart people, and we think privately held companies are better situated to consistently do that. And then secondarily, there's less agency conflict. What do I mean by agency conflict? Essentially, if you're good at picking stocks, if you're consistently adding alpha in your stock selection, you will get compensated. In our society and in the way our economy works, the only thing better may do is hitting a curveball or hitting a 3-point shot. Outside of that, you're going to get paid pretty well. But if you're a publicly traded shareholder, you're also going to demand to be compensated for the risk of owning that security. In a publicly traded environment, there are essentially 2 mouths to feed. In a privately held company, the PMs are the shareholders. The shareholders are the PMs. So there's less upward price pressure on fees because of that reduction in agency conflict. And we see that reflected in about 13 basis points of lower fees privately held companies versus publicly traded companies. So you can think of that as about 30% of the advantage is actually coming from lower fees. Maybe 70% of that advantage is coming from culture, but some of it's just a direct representation of lower fees in privately held companies. We're all familiar with survivorship bias. You know, that essentially if I'm looking at results in 2016, and I'm looking at all the managers that are available in 2016, and I want to go back over the last 10 years of results, I've got a real bias issue because I'm only looking at the winners. The managers that are still in business in 2016 are a different set than were available in 2007, 2008, 2009, when a lot of people have gone out of business, been merged, or eliminated. Now, we account for that. In all the data analysis we do, we add back in all the dead and merged funds and all of their data. So anytime I'm looking at a date, I'm looking at all of the funds that were available when that decision was being made. But one of the folks in my team came to me one day and he goes, what if survivorship is not just a data issue? What if there's a signal tied up in here? And I said, sounds intriguing, tell me more. And he goes, well, think about it. If a manager is going to launch a bunch of funds and then keep the winners and then do that again, don't they have an economic incentive to run that play consistently? And won't we benefit from deselecting the managers that do that a lot? And I said, okay, I like that. I like your thinking. Run the analysis. So he did. This is a kind of a complicated chart, so let me explain it. The zero line is the market. Essentially, the S&P 500. Each bar chart on this chart is a fund complex, a family. Now, the first thing to think about is that 3/4 of fund families in the aggregate aren't adding value. That's alarming. 1/4 of them are, so that's good. Those are the ones that are consistently doing better than the market as an aggregate group, not an individual fund, but their entire aggregate exercise. But now let's look at survivorship. These are the fund families that have merged or eliminated funds more consistently or more actively. They're in the bottom quartiles on survivorship. These are the fund families that have done it less often, that have been more durable and more long-term. Do you see more light green above the line and more blue below the line? Turns out, survivorship is a really powerful signal. You know, the fund families that had negative excess returns, 75% of them had lower survivorship. Of the fund families that had positive excess return, 70% of those had higher survivorship. Now, you might be asking yourself, Steve, isn't this perfectly circular? You know, of course the fund families that didn't do well are going to kill more of their funds. And the families that have done well are going to kill fewer of their funds. And that would be true if I didn't do the out-of-sample test. I also tested this in 2 different time periods. And I identified managers in one time period, high survivorship, lower survivorship, and I looked at their results in an out-of-sample future time period and asked myself 2 questions. 1, do they do it again? And they did, in terms of, you know, throwing a bunch of spaghetti against the wall and keeping what worked. And 2, were the results equally predictive on the future results? And they were, worth about 15 basis points of excess return. Sometimes not choosing a manager is as valuable as your reasons for choosing one. Deselection can add value as well. You know, we already talked about expenses. They really matter. Expenses are an important element in everything that we do. And our expenses have tended to be lower, and this is asset weighted, this is all share classes. If I just look at the F3, R6, our institutional share class, our expenses are actually closer to our passive peers than they are to our active peers. And it turns out that's contributing about 25-ish basis points of our 170 basis points of excess return. So in other words, if we were just as skilled, but the same price as our peers, we'd have 140 basis points, 145 basis points of excess return. We only get to 170 because we're not only more skilled, we're lower cost. We already talked about skin in the game and manager ownership, but I want to give you a highlight of just how powerful this is. This is the quartiling of manager ownership. So the first quartile will get the highest degree of manager ownership. Fourth quartile is lowest. This is domestic. This is large cap foreign. I mean, it's incredibly predictive, particularly that first quartile. I mean, being in that highest degree of ownership dimension really helps to separate better managers from the rest of the pack. Another way to think about culture and investing decision is that there's a tremendous pressure in our industry to be more short term. What were your quarterly results? Did you beat the market in this year? And we try everything that we can do to extend time frames, to get people to think more long term about investment decisions. Because while I may not be a believer in the efficient market hypothesis as an absolute rule, I believe it's generally true, particularly over shorter time periods. So there is a random walk over the next 3 to 6 months, and if I really want to separate myself from the results in the market, I better have an insight that is different than the rest of the analysts out there, and those things tend to reveal themselves over longer time frames. And this is all tied into incentives as well. We found that for managers, the longer period you give them as an incentive compensation, the better they do. So in other words, managers that have a 1-year compensation structure don't do as well as managers that have a 3-year compensation structure, and they don't do as well as managers that have a 5-year compensation structure. Turns out, encouraging people to think long term helps separate them and their results from the market more broadly. And at Capital, we focus on a 1, 3, 5, and 8-year compensation structure with an emphasis on the 5 and the 8. And we're really trying to get people to think about a full market cycle. This also manifests itself in turnover. This is the industry turnover for mutual funds and our active peers. It's about a 50 to 100% turnover. Obviously when you get to 100% turnover, you're making your entire portfolio is rolling over within a 12-month period. So if you're averaging 50 to 100%, you're looking at a 18-month holding period. It's hard to differentiate yourself over that time period. Our turnover's been between 20 and 40%. So we're holding securities for 3 to 4 years, which gives us a much greater chance of differentiating the market, but it also saves us money on transaction. The actual friction cost of turnover, we've done the analysis, and it's worth about 2 to 10 basis points on average versus our peers. Now, 10 basis points isn't enough to separate our results from the pack, and it's not enough to choose us. But it's a part of our disciplined, systematic process that contributes to our success and is another, so think of it as an uncorrelated element to our other alpha-generating activities. So having that savings embedded into our structure is an advantage. Multiple managers matter as well. We have, in the Capital system, a unique approach where we have as many as 12, 14 managers on a fund. And we think there's a tremendous amount of value in that combination of high conviction plus collaboration without the requirement for it to be consensus or a committee-based approach. And we've found that funds that have 3 or more managers did do better. It's kind of a soft finding. I don't think it's a good representation of the Capital system yet. This is one of the things we're looking at this year to go deeper on. We were able to do some analysis that would look at our funds relative to our peers and say, well, maybe GFA does better because there are 12 managers. And what if we combined 12 mutual funds and then resample 12 more mutual funds and then resample 12 more? Maybe it's just the benefits of diversification. Maybe it's not the fact that we've chosen these folks. And every time we did this analysis on GFA and other funds, we found the same thing. is that it was not just the benefits of combining 12 mutual funds. You've got to have the right people. You're choosing investment styles. There's an art and science in how we're connecting these teams and how they work together. Obviously, 12 mutual funds independently managed, there's no sort of Socratic dialogue amongst those managers. The 12 PMs that we've got managing GFA are actually meeting and talking about the fund. We're also super focused on the downside and avoiding the worst. We tend to have less than 100% upside capture. So in a good up market, we're probably at 97% upside capture. But we do more of our value creation in avoiding the downside. You see that here and kind of looking at the worst periods, both domestically and internationally. And certainly the longer you give us to manage the money, there's more opportunity for us to express that difference in downside. And you really see it when you look at sort of an attribution analysis of our results. If we've had 116 basis points of excess return versus active peers in this particular time period, more than 100% of it, 178 basis points, came from downside capture. We actually gave back to our peers 62 basis points in upside capture. Even more to passive, but we made up even more for that versus our peers in downside capture versus passive. So avoiding the downside really matters on two dimensions. One, mathematically it keeps your assets intact and allows more of them to be available in the next up market. But two, imagine a return stream that has lower than 100% upside capture, but much lower downside capture. What do you have? It's a lower volatility return stream. And there's an opportunity to have both excess return and lower volatility. And we see that in our results. This is our average excess return over active peers and passive peers over the last 20 years. And this is the volatility advantage that we've had versus our active peers and passive peers over the same time frame. So we'll produce these results while producing a lower volatility return stream, which obviously really matters when you're thinking about glide path construction, folks at 65 that want 3%, and certainly when you start taking money out of the portfolio, which exacerbates volatility itself. So the implications for manager research and model development are, first, there is no silver bullet. I don't believe there's a single factor that defines anything in the investment world. You've got to look for multiple factors and combine those to improve your success rate. But you can. I mean, if 20% of managers beat the index every year, it feels like an irrational decision to go active. Through this screening process, we've developed an approach that the cohort of managers who meet these screens beat the index 80, 90% of the time. Now, that's a very different decision. Now it's really rational to choose an actively managed program if you can get that level of success relative to the passive index on expected return. We think you should seek both excess return and lower volatility. That's one of the benefits of active management, is that you're not yoked to the market in a complete, sort of market volatility. You can do better in periods of market volatility and downturns. I think implementing models based on established research makes sense, and one of the things that we're looking at, and I would certainly propose, is that we consider a baseline and test model approach. So you've got your baseline model based on whatever criteria you're using today, and you add a new model, it's a paper portfolio, and you look at additional factors, and you evaluate that over time, and see whether or not your test model is beating your baseline model. And if it is consistently over time, you might consider incorporating those factors into your manager selection approach more readily, because you've got some actual, sort of ex-ante results to go on. So I know I've thrown a tremendous amount of research at you, 5 years of data in just 30 minutes. So I would be happy to take any of your questions and talk about where we go next. Question here.
Many firms only use fundamental research, and many others use fundamental and technical, or at least technical in timing when to buy the stock and when to sell it within days or months.
Yep.
But there are two firms in addition to your firm
Yep.
that does not use technical and have had very good results. One is Sequoia,
Yeah.
up until just recently.
Sequoia
And
has a
the other-
connection to capital.
And
too,
the other
by
is
way.
Berkshire, and they would not ever look at a technical sheet of any kind,
Yep.
whereas Capital's approach.
Yeah. Sure. And you know, it's interesting. We essentially think that the elements that go into technical, you know, charts and market timing are much, maybe even distracting to the much more important question of, are you believe the story in management? Do you believe in the security? Do you believe in where it's going over a longer period of time? And so I think that we've not seen enough you know, value in adding that to what we're already doing to include it. And I do think that we're hyper focused on avoiding things that might distract the managers, the PMs, from their primary mission, which is to find great companies, find great management teams, and invest with them over the long term. One of our PMs calls it, you know, private equity investing in the public markets. Is that we actually align more closely. We do have a connection with Sequoia, or some of the folks that were involved there that were part of Capital when they started. And I think that's been something that's worked pretty well for us. That's not to say that we won't look at other elements on an ongoing basis to see if they add value. You know, one of the things we're looking at right now is machine learning and artificial intelligence. And we're still fundamental, we're not a quant shop, but can you use a fundamental analysis and add machine learning and AI to that fundamental process, and essentially can man plus machine beat man or machine by itself? And we are looking at those things. I mean, one of the things, you know, we talked about manager selection recently. I did an AI test on manager selection. So it was a contest. You got a data sample of mutual fund results, and your job using machine learning and artificial intelligence was to predict mutual fund results in the future. That was the job of the computer. 16 teams entered, multiple iterations of models, and it was fascinating to me because, one, they got pretty good. The models got good pretty fast because they're iterating through so many different approaches. And two, the models that won, that did well, pulled on some of the same foundational fundamental characteristics that were identified in our earlier research. So, you know, I think we can both learn from, you know, there's not, you don't want to stop in your learning. You never want to say you're done. You want to continuously test and learn. And so we're certainly open to that. We've spent a fair amount of money. I mean, we're not, as I said, we're not a quant shop by any stretch, but we have probably a couple hundred people in the firm that are more quant oriented. You know, we're helping the PMs think about ways of applying quantitative screens or quantitative analysis to existing fundamental research. So, sure. Question here.
How are you quantifying kind of firm or ownership by management? Or
Yes.
Is it an absolute level, or is it based on the size of the fund?
It's absolute. The SEC only gives us a certain amount of data. They have it in 7 buckets: 0 to 10,000, 10 to 50, 50 to 100. The last bucket is $1 million or more. So you lose all the information above $1 million or more. You don't really know if it's 2 million or 10 million. But it turns out $1 million or more is a good rule of thumb. It typically puts you into the first quartile, and typically puts you in that high level of manager ownership. You know, a lot of folks have asked me, you know, what is that as a percentage of their net worth? And I'm like, well, I'd love to have that data, but I have the SEC data, not the IRS data. So I can't tell you what it is of their net worth, but I can tell you that $1 million, particularly as you look at the firm level, if I have a firm that has one manager who's invested $1 million in their fund, all right, that's great. But if they have 30 funds, it's not part of their culture. So I actually look at what is the percentage of assets that the firm is managing, and what percentage of that is managed by a manager with at least $1 million in their fund. That matters. Now you're identifying culture at the firm level versus individual fund. And just to give you, one highlight, 99% of the assets in the capital are managed by a team where at least one and typically multiple managers have $1 million in the fund.
One add-on piece just for anybody in the room. If you want to see this research in hard copy format, let me know and I'll reach out to see.
Yeah, we've got
make
it.
sure everybody's got it.
Weekend reading, yeah.
Yeah, light, fun.
Well, it's
right?
one of the groups that may actually be interested in that. Yeah. Not true for all of our audiences.
But I think a lot of the screening methodologies, so to the extent you're looking at, hey, I want to run this more broadly, because it's coming from the other side, I do think that's what matters, right? You need to apply this broadly. That methodology is outlined in there. So I'm looking kind of in Director and Zephyr, how might I run this?
Question?
The excess return that you're able to generate at the firm level, if you look at that distribution, was that relatively consistent over time, or did you get a lot of it in one period and it kind of levels off?
Yeah, it's a great question. It was relatively consistent over time. It has been, though, within that, produced more of our excess return in down markets than in up markets, as I talked about the up market capture and down market capture. And it has come down a little bit. I think our excess return is still really positive, but it's not quite as high as it was. Our success rate relative to the overall market has been as strong. So when we think about success rates, just did we beat the broad market? Every bit is good, but the marginal contribution has come down a little bit, but still well over 100 basis points in more recent time periods. So the last 10 years, from a success rate perspective, has been accretive to our long-term results, but slightly dilutive in terms of the magnitude of those results, probably just related to the fact that markets have been up over the last 10 years, and it's been harder for us to demonstrate the same kind of excess return as we do in a more volatile or down market environment.
Anecdotally, you come across a lot of funds that have a great track record, but maybe a lot of the outperformance was in the first few years when there was very low assets in the fund. It wouldn't serve capital well, but do you have any data around
Size
of the fund,
Yeah.
the ability of the manager to be nimble,
Yeah.
and returns?
Yeah, it's a great question, and I do think size is an issue, and there's certainly elements of size that are a headwind, if you will. Think of it as costs and friction of trading. If you're smaller and more nimble, you can actually get in and out of a security within the daily trading window of that security. Capital does not have that opportunity. It takes us weeks to get into or out of a security, and during that time period, we will push the price one way or the other, and we pay the price for that in the cost of our trading. But if that's a headwind, we have to balance that against the tailwinds of much lower costs, the benefits of our scale, obviously as an advantage, and frankly having 270 plus investors around the globe and still keeping our costs down. So we think of that as the tailwind of size. When I look at size on an absolute basis, it has not been a predictive measure of success one way or another. There are good large managers, there are good small managers, there are bad large managers, although it's kind of strange to think there are bad large managers. You'd think that people would take their money out. And there are certainly bad smaller managers. So size wasn't an absolute predictor, and we've been able to, I think, more than mitigate some of the headwinds of our size, in part by being systematic about lowering our fees and using the benefits of our scale. One more question here. Sure.
Looking at history, there have been one-man firms, so to speak, or notable people, Jerry Tsai, Peter Lynch,
Yeah.
many others that have had fantastic records. But you've avoided that with your slide that says, well, we have 3 people on an account and they must decide individually, not individually, but the 3 must decide to do something.
No, individually. The 3 don't have to agree.
Okay.
A manager A can influence manager B in their conversation, but manager A can just say, I'm doing it even if you don't agree. Manager B can come to a different conclusion. So to me, it's this interesting interplay between diversified approach approaches, high individual conviction, and some benefits of collaboration across that.
There's no backup on that manager. For instance, looking back at Sequoia, you're familiar with Mr. Goldfarb, I think.
Sure.
And that was a system that did not work. And you don't have that problem as I view you.
Yeah, I think there's a real benefit in not relying on an individual manager. I spent some time at Fidelity, so knew Peter Lynch and Harry Wang and Stanek.
It's never worked long term.
No, but I was thinking, you look at just Magellan. There were a period of time, 5 or 6 years, when the portfolio swapped out 100% of the time, multiple days, because a new manager came in and made a different set of decisions. So we don't have that. I mean, when Gordy Crawford retired a few years ago, from GFA, we had already tapered off his position, anticipating his retirement, and he was no more than 5 or 6% of the portfolio when he retired. Someone else was picking that up, and so you get this kind of seamless transition. You don't get the all or nothing. We went from the Gordy era to the XYZ era. I mean, Gordy was never more than probably 10% of the portfolio, even in his heyday. So that is a very different approach.
Just say a very small point, but whether it's the technical analysis question or it's multi-manager stuff, there's a lot that ends up applying purely to capital versus more broadly, but I think it's really interesting just to note at Capital Group, managers and analysts are not paid on AUM. They're paid purely on their results on rolling 1, 3, 5, and 8-year periods, the largest component on the 8-year periods. And so it's a natural incentive not just to gather assets, but deliver results. And so you can get around somebody who is Gordy Crawford, who is walks on water internally, externally might be limited to 10% of the portfolio.
Sure.
It's really just giving you results.
Thank you.
I really appreciate your time. Appreciate the good questions. If there's anything else along the way after this, Jeff knows where to find me. So I really appreciate the opportunity to spend some time with you. Thank you.
Thank you.